Governments fight the coronavirus. Markets react, sometimes violently. This is Bloomberg Wall Street Week. I'm David Westin. Welcome back. This was a week we saw things we never thought we would see. We saw oil trading in negative numbers. We saw the government pony up with as much as $3 trillion to help the economy. Well, the equity markets, they were all over the place, maybe doing better than they had any right to do. On top of it all, the iconic NFL draft, well, we got to watch that from Commissioner Roger Goodell's basement. It is a strange new world, one we don't understand, and one that we know somehow we'll make through. We're just not sure exactly how or when. But when it is the case that we don't quite understand what's going on, that's when we turn to the markets, isn't it? Don't they tell us what's happening? Well, let's ask that question to our Wall Street Week contributor, Afsaneh Beschloss. She heads the Rockcreek Group after a distinguished career at the World Bank and the Carlyle. So, Afsaneh, thank you so much for being with us today. Explain the markets exactly, because although they are down not nearly as much as what the economic numbers might indicate.
David, this week the markets were all over the place, as you said. And what is really interesting is that people are comparing this week a little bit like to settling down post this being sort of 6th week of the shutdown, and comparing it to sort of after the war, or after, sort of post-COVID will be after a wartime economy, or post-2008. And I think we are in a very, very different situation. We are in a situation where you have a lot of zombie companies in the mutual funds and ETFs that are getting carried through with the good companies. And at the same time, you have a lot of companies that do have strong financials. And I think for investors, there is a big move towards getting into higher quality companies with better financials. And last but not least, what was really interesting this week and last week was that companies that have a higher ESG rating, both in US and Europe, did relatively better.
So, Afsaneh, is that all right? You're responsible for putting money to work. Does that mean this is maybe the resurgence of active investing? Do you have to actually pick the stocks now instead of the ETFs?
I think no question that you do need to look much more at active investing. I don't want to say that it's time to short the index funds and the big passive providers, but at the same time, you have to be in companies that are going to do well, and they might be larger companies, but also a lot of smaller companies that are benefiting from the conversion of technology and finance and technology and education and technology and medicine. So we're looking at both ends of the larger and the smaller companies that are innovative, that are responding to what is needed. And also the companies that are behaving better to all their stakeholders seem to be the kinds of companies that you want to be invested with in the longer run.
Afsaneh, when we talk about a wild week, that certainly was the case for oil, where we actually saw WTI futures trade in the negative, well into the negative, actually. You've spent a fair amount of time in the energy sector in your career. Could you give us a sense of what's going on there? Is this a longer-term trend?
No question, David, that this is a long-term trend in terms of demand has been going down as energy efficiency has been improving. And even before we had the COVID virus shutting down all economies globally, you had this sort of trend going on. If you look at what is, I think, very interesting this week, of course, is with the futures market. And every retail investor and Gen Z who was invested in the retail futures market through the USO or other kinds of funds so got to learn in the hard way how oil markets work. So I think contango became a household word. But in terms of energy markets, I think longer term, if we put aside the problems with oil storage, which are filled now to the brim, and even on the oceans, the tankers are full. If you put that aside and the fact that demand is not coming back so fast, looking longer term, I think what has been really interesting is if you look at the behavior of oil consumers and oil producers. if you looked at 2014 versus 2016, you did have a phenomenon where oil prices went down from about $100 to about $45. And that was a huge shock to oil producers and oil exporters in particular. And what you saw is that they cut down on their spending, and they also had to go into their sovereign wealth funds or their FX and spend a lot. This time round, I think you will see that in even bigger doses. And one of the interesting events this last week was that in Russia, where the foreign reserves were supposed to last about 8 years, what they're saying now is that this year only, in 2020, they'll have to use close to half of their reserves, and maybe by the end of 2021, they'll be finished with their reserves. So that's a lot of change to oil producers and oil consumers. And I think one big boom as we come out of the COVID-19 pandemic is that finally the impact of lower oil prices will help the consuming countries, and their economy will grow a little faster because of cheaper oil.
Yeah. Really good point. There are some benefit factors actually from this. Thank you so much to our Wall Street Week contributor, Afsaneh Beschloss. Coming up, Congress moved forward on another $484 billion spending package to help the economy. But is it enough? We asked the Speaker of the House, Nancy Pelosi.
We started with testing on March 5th. Here we are a month and a half later, and the administration has still not fully implemented it. After this bill, hopefully they will.
That's next on Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Westin. Congress this week took what was already an unprecedented level of support for the U.S. economy and upped it by another $500 billion. We asked Speaker of the House Nancy Pelosi whether there was more on the way, despite the fact that the Majority Leader, Mitch McConnell, says they've already done enough.
Let me just say how pleased I am with what is in the bill, and I thank you for the opportunity to do so. 2 weeks ago, the Secretary of Treasury called me and said he needed $250 billion in 48 hours. Republican leader went to the floor and said it's $250 for the program, and that's it. We're not making any other additions. We objected. The Democratic senators objected. We worked together for our proposal. They objected to that, made a counter proposal, which was resoundingly rejected by the Republicans. And for 1 week, they refused to negotiate until about last Thursday. Then they realized that they had no chance just to do the $250. There was so much more urgency. And in the bill, we, of course, support the $250. That was part of what we helped put together in the CARES Act. We support our small businesses, their entrepreneurial spirit, their optimism, their source of jobs and creation of wealth in our country. There was no question that we would be supporting that. But it took them a longer time than it should have to agree that we needed to make sure that even the smallest of small businesses would be included in that, and that we would be addressing our health needs because the key to our opening our economy, the key is testing, and we got $25 billion, as you mentioned, and the $75 billion to our hospitals for all the purposes that serves. And so finally, they agreed to the package we put on the floor at the time. In fact, we even did more. In addition, that we can move on to the next phase if you wish now.
Does this take care of the rescue part as opposed to recovery? In the past, you've talked about rescue versus recovery, and talk specifically about state assistance to state and local governments. Do you regard that as part of a rescue or recovery, and what are the prospects of getting that done?
Well, I was placed in 3 phases. First, emergency, and that's what we did in the first few bills that we passed in March in a strong bipartisan way. We started with testing on March 5th. Here we are a month and a half later, and the administration has still not fully implemented it. After this bill, hopefully they will. So So that was part of recovery. And then we went into mitigation, to mitigate for the damage to the economy with these initiatives to protect our small businesses, to provide more assistance in terms of health care and the rest. And now we have to go further into mitigation, unfortunately, to help state and local. Now, state and local means this. It means the healthcare worker, the police and fire, the first responders, the emergency services people, the teachers in our schools, the transportation workers who get vital, essential workers to work. Again, it's about the people. And these people are risking their lives to help save other lives, and now they're losing their jobs. So it's very essential that for our heroes, I call it our Heroes Act, that we have this assistance to state, county, local government, and to do so in a very significant way, to recognize the lost revenue that they have from lack of a stream of revenue because of the economy, and secondly, the outlays that they make in order to address the coronavirus.
Take us through your strategy in agreeing to this approach, leaving out state and local. You did get, as you said, hospitals, you got testing in and protection for some of the smallest companies. But did you run the risk, perhaps, of not getting the state and local assistance, certainly anytime soon? Because now we have Mitch McConnell, the Senate Majority Leader, saying he thinks he's maybe sort of done, he's cautious going forward. Even Stephen Mnuchin, your partner in negotiating a lot of this, is saying he's not sure we need a lot more. Are you concerned we won't be able to get the state and local anytime soon?
Well, first of all, let me remind you, this is the same Mitch McConnell who said on the floor of the Senate 2 Thursdays ago, there's no way we're going to do anything but the $250, and now we're up to $480 that the Democrats were able to add for smaller businesses and for the health and well-being of the American people. So that's an interesting statement, but it isn't the fact. This is an interim bill. We didn't expect to have an interim bill, except after the Secretary's call. So we went from CARES 1, and then we're going to go into CARES 2. And CARES 2 would have been about state and local. So we got everything we asked for on the floor of the Senate and more 2 weeks ago. They should have agreed then instead of holding it up to what they agreed to yesterday. But in terms of state and local, the president himself has even said, and he tweeted out, that he's ready to do state and local, that he knows there has to be another bill. And there are other measures that are needed to be addressed in that legislation as well. It's going to be a major package. It's going to address, again, the needs of the states and localities, because that's where much of the healthcare delivery is, in public hospitals and the rest, as well as testing and that is in our bill that will be dispersed in some of it to many of the states out there, some of the money for testing, and also the lost revenue. This is a very important point. The lost revenue is something that we will have addressed in this next care package to recognize that piece of it, and that it has to be compensated for, and funds used, given to the states, can be used for that, because it is all coronavirus related, and everything we do is about coronavirus related. So it is with great optimism that we go forward with this. We're well down the path to do it. It was never intended to be an interim bill because we didn't know an interim bill would exist. But we used the interim bill to make the argument that this needed to be done as soon as possible, and it will.
This needs to go for coronavirus, and specifically for need. How do we make sure that these funds, massive funds, are not distributed with any political reason involved? Because with the PPP, there was some suggestion more funds were going to some of the states that tend to vote Republicans. Are you confident this is going where it needs to go rather than where it might be politically exigent to go?
Oh, of course not. But anyway, I think the public display of it, as Abraham Lincoln said, public sentiment is everything. With it, you can accomplish almost everything. Without it, practically nothing. But I might add to that I do think that it's not too soon, and should have been even earlier. We have to get ready for what comes next. How do we open up government? How do we do so in a way that does not contribute to a return of the virus? And if we have, God willing, a vaccine soon, how is that distributed? Not in a political way, but in a way that meets the needs of the American people. That would be sinful. But it is a challenge, and proper preparation prevents poor performance. That's what the Boy Scouts say. I wish the president would act like a Boy Scout in that regard and be thinking ahead, not just, and I'm prepared not to look back to some of his statements, but he cannot continue to misrepresent the facts to the American people and expect us to accept the deaths that go with that.
Okay, Madam Speaker, final question. Looking forward, the way you say we need to be doing seems exactly right. What do you look forward to in terms of an election in November? Do you have any sense of what that may look like, as you say, to make sure that people are safe, but they do get to express their views at the polls?
We want to be able to have people vote by mail. Especially at a time of concern about health issues, it's better for them to vote by mail, to get their ballot sent to them at home, to have same-day registration for those who do want to go to the polls, but to have the demand on poll watchers and the rest be much, much less. So we will be seeking additional funds. We had $400 million in the first CARES Act. We need much more than that now so that we can guarantee the integrity of our elections. So we're talking about the lives of the American people, the livelihood of our their livelihood and the strength of our economy, and the integrity of our elections, the life of our democracy. This is very, very important. Now, more than ever, more important to be able to vote by mail.
That was Speaker of the House Nancy Pelosi. Coming up on Wall Street Week, we talk with UPS CEO David Abney about how the crisis has changed his business and the U.S. economy.
Even when this crisis is over, we're just living in a time of great change. So we think we will continue to build upon that.
This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Westin. Home delivery has gone from something of a luxury to a true necessity. And an important part of the backbone of that home delivery system is UPS. We talked with Chairman and CEO of UPS, David Abney, about how this crisis has changed his business and the entire U.S. economy.
What I'll say industry-wide, so from a whole macroeconomic standpoint, is obviously a lot more health care, PPE, and critical shipments like that. And I think you're seeing that all across the industry. And with businesses being closed and with people sheltering in place, you see more e-commerce, more residential deliveries across the industry too. So that would be the two biggest things. And the good thing about our flexible global logistics network is it allows us to flex to meet the needs of governments or meet the needs of our customers. So it's interesting times, that's for sure, David.
Yeah, that's for sure for all of us, David. Let me pick up on what you just talked about, that flexible logistics, because you really have pushed hard on automation and bringing the computer, the digital age, into your delivery system. Is this experience going to expedite that? Is that going to drive it even farther and faster than you were doing already?
Well, one, it makes us very thankful that we have invested in the automation and invested in our transformation initiatives, which were all focused about speed and focused about agility. And of course, with the situations we're facing now, that just stresses the importance. But even when this crisis is over, we're just living in in a time of great change. So we think we will continue to build upon that. So it's just more important now than ever, and I don't think see that diminishing once we get through this crisis.
Thus far, your experience with the UPS, does it tell you anything that would really be helpful to us about restarting the economy? What you've seen shut down, what you think might come back?
I do think we can add a lot to that story, and I'm proud to be a part of the Great American Economic Revival Group, one of them that the president is leading. And the thing that we have to offer is that since we have been declared a critical infrastructure business, we've been operating through the heroic efforts of our UPS drivers and loaders and pilots and mechanics throughout this crisis. And so we have learned a lot, and one of the things that I will be sharing with other businesses that have had to close down is what we have learned, what we see works, and what we would recommend they do and not do. So I do believe that we would add a lot of value to that discussion.
David, talk about those employees. What are you doing for them to try to keep them as safe as possible? What extraordinary lengths are you going to?
Okay, certainly will. In fact, my favorite subject is talking about our employees, especially right now. They're just an amazing group of people that realize that we're a critical business, and they have stepped up to the plate like I haven't seen. In fact, David, we have record service levels now, and I can go back 46 years, so I can't speak for the company history, but I can speak for a good portion of it. And but the first thing is all about the safety. We have to, if we want to be a critical business, and if we believe we've got to move healthcare supplies and stuff around the world, then we have to take care of our people. And things like, and these are some just real important things, emergency paid leave that was outside of our union contracts that we agreed to let our people know you don't need to come to work sick, that if you are feeling any problems, we can give you the paid leave. And enhanced cleaning of our buildings and our package cars and everything that people touch. Of course, following CDC guidelines and sanitizing supplies and masks. But one that was really important, you may have noticed it if we delivered to your house, is no longer drivers having to require signatures. And so that means this diet board, this computer is not being passed from hand to hand. And we have learned how to make non-contact deliveries. And those are things that have made the job much, much safer and is allowing us to continue to function, but is due to the amazing efforts of our people.
We certainly have seen that at our house, I'll tell you that. David, you were going through a transition before all this crisis came up. That is to say, you have a new CEO coming in, I think June 1, and you're going to remain as executive chairman. Has this crisis and your response to it changed at all that transition? We've seen that at some other companies.
You know, it hasn't changed the timing. It's changed the process just a little bit. I mean, when we first started together, Carol and I, she was kind of shadowing, we were doing things together. Well, now we've been doing more virtual shadowing, right? And so that has changed a little bit, but we're still getting her out to meet our people. It's just through virtual means versus in person. But the great thing about this is she's been able to see firsthand how we're dealing with this crisis, and she will be off to a running start. And with the questions about what's the economy going to do in the remainder of the year and those kinds of situations, having someone like Carol Tomei's background and real emphasis on the financial side of it, and having lived through the Great Recession with her in her previous life, it just has convinced me more and more she's absolutely the right person at the right time. But the transition has been differently than what we planned, no doubt about it.
That was David Abney, CEO of UPS. Coming up on Wall Street Week, he's been a leader in Washington and on Wall Street. Ralph Schlosstein of Evercore on how the world of investment and corporate deals has changed fundamentally in the time of the coronavirus.
I'm confident that our recovery will be dramatically slower than falling in the recession.
This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Westin. In the pre-COVID world, investors would look at things like how the economy is doing, which sectors are most likely to grow, and which companies are best positioned to take advantage of that growth. But now governments are pumping trillions of dollars into the global economy. We talked with Ralph Schlosstein, head of Evercore, about how that changes the rules of the game.
The depth and the rapidity of this recession is staggering. At the same time, you have equally unprecedented reactions on the part of both the fiscal authorities globally and certainly here in the United States, and central banks, the monetary policy, and particularly our Fed. So what the market is really struggling with is, on the one hand, massive and unprecedented and rapid destruction in the economy, the real economy, which is going to affect corporate earnings, and on the other hand, trying to look through that and seeing $2.5 trillion of fiscal stimulus with the 3 stimulus proposals or laws, and that is also 3 times the stimulus that we had in the Great Recession. And the monetary stimulus, the Fed started out buying $100 billion of treasuries and mortgage-backed securities a day, the most that they ever bought in a month during the Great Recession was $100 billion. So in one day, they're doing what they did in 1 month during the Great Recession. And so, ultimately, the fiscal policy and the monetary policy will mitigate the depth of the downturn, and it will precipitate a recovery. But we really just don't know how long that's going to take.
How long it's going to take, Ralph, but also how much of a recovery? I mean, there's lots of talks about V's and W's and J's and U's and things like that. Do you think a year, 2 years from now, we'll be close to where we were a year ago?
I think it's highly unlikely that the ramp upward will have the same slope as the ramp downward, and that's because, as I said, we're dropping off a cliff economically, and unfortunately, until the economy starts to reopen, the stimulus will basically be a tiding over. It's not really going to provide any stimulus for a recovery. You can't recover when so many of your small businesses are closed and when so many of your factories are closed. So it will hopefully help sustain people who are on unemployment and have lost their jobs, many of whom don't have much money to tide them from 1 week to the next. But in terms of getting the economy going again, I'm confident that our recovery will be dramatically slower than the recession, falling in the recession.
Let's talk about your business a bit, Ralph. I mean, you had your earnings statement recently, and you already had done some retrenching for some softness in the marketplace. How is this going to affect Evercore?
Well, our biggest business is M&A, and M&A relies basically on a number of conditions to behave normally. It relies on a reasonably stable and well-valued stock market. It relies on high availability of credit. It relies on a reasonable judgment or sense of where the economy is going, and it relies on CEO confidence. The last 3 are not present right now. There's not readily available credit. We have no idea how the economy is going to evolve over the next 6 to 12 months. And as a consequence, CEO confidence is low. So our largest business, M&A, is clearly going to be quite negatively affected. The good news for us is that we've invested heavily in businesses that help where we can advise companies on their balance sheets, either in restructuring or advising them on debt or on equity capital raising. And so we're very busy, even though we're spread out among 1,800 offices around the globe. But the businesses that I just described aren't big enough for us to offset what will be a pretty significant decline in M&A activity for sure.
That was Ralph Schlosstein of Evercore. Coming up on Wall Street Week, Citi Global Chief Economist Catherine Mann on whether equities are counting too much on government help.
So it's no question that the equity markets are responding to the combination, the double-barreled Fed and monetary policy.
This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Westin. Economic numbers continue to deteriorate, and it doesn't look like we're at the bottom yet, which raises the question, are equity markets underestimating how bad it can get, or are they fully estimating just how much governments are willing to do to save the economy? That's something we asked of Catherine Mann. She's the global chief economist for Citi.
If we go back a little bit of it, a couple of months or so, the markets were in free fall. The markets were absolutely in free fall until the Fed came in with its program, not the rate cuts, that didn't help, but with the first round of alphabets of backing, and then the markets still were on the bottom until the fiscal authorities came in with their huge program. So it's no question that the equity markets are responding to the combination, the double-barreled Fed and monetary policy, on fiscal policy. On the other hand, it's also the case that when we look at where they bounced back to, we sort of say, okay, they bounced back to where they were in the middle of 2019, maybe not to the highs of the beginning of 2020. Middle of 2019, where do we think the economy is going to be in 12 months? Are they looking forward to that? Because if they're looking forward to that, they shouldn't be where they are now.
And Catherine, one very interesting point that you've made is this. Everybody talks about, is it a V, is it a W, is it an L, is it a U, things like that. Your point, I believe, is it depends on where you look, and specifically at what sector. It may be a different letter for different sectors.
So a couple things. First, different letters for different sectors, and it's also different letters depending on what your time horizon is. So let's talk about the sectors first. Something like a manufacturing, much more like a V shape, because, when the factory is shut down, you run down the inventories. When you have to ramp up production to make back up your inventories. Maybe not as much. We are tempering the Vs a little bit because the supply chain continuity matters. Your factory may be open, but the next factory on the supply chain may be closed. So, you've got some tempering of the V shape in manufacturing through that relationship and the fact that the whole world is not opening up at the same time because the virus didn't arrive at the same time. The other set of sectors, though, for example, are ones where consumer choice matters. We call it getting back to play, meaning people are going out to entertainment, restaurants, sporting events, travel, tourism. Of course, people in those sectors they are the workers in those sectors. They're the employed people. But it matters whether or not there is consumer demand for those unstructured activities, things that you do by choice. Nobody's forcing you to go take a cruise. And so until that really gets back, those sectors, the workers associated with those sectors, and therefore the economy as a whole, is going to have a drag. It's going to be L-shaped for them. And so you get these very different shapes depending on the sector. You add it all up to an economy, and some of them are a little bit more V-shaped because there's a little bit more manufacturing, a little more tech maybe, and then other economies that might be South Korea or Taiwan. And then there are other economies that are extremely tourism dependent. Those are facing L's, something like a Thailand, Singapore, or UK. These are economies very dependent on consumer choice sectors. The other perspective, though, that I think is important to remember is, depending on what is your time horizon as an investor, if you are a very kind of a near-term, short-term time horizon, you're going to see these just amazingly collapsing economies on a quarter-to-quarter basis. So into the second quarter for advanced economies for most of the emerging world, except for Asia, which is being changed by China. And you asked the question, when does the economy get back to the peak of economic activity as measured by, say, January 2020? How long does it take? Probably takes 12 to 18 months. It means for the economy as a whole, things are bad until you get to 2021, midway through 2021. So what does that mean to you as a corporation if I told you your revenues weren't going to be back to their peak for 18 months? You know, that's a pretty tough thing to be thinking about if you're a corporation.
Finally, we're going to hear from the central banks again, with the Fed, for example, next week, and a series of other central banks. We've heard an awful lot from them already. They've done an awful lot to support the economy. Is there more to come? And if we essentially lapsed over to monetization of debt as a practical matter?
Well, the Fed has made it very clear that they feel like they have as many instruments as they need, depending on the situation. My guess is that I think they knew that there was going to be this degree of fallout. They still have a lot of opportunities to get involved in the various markets, the financial markets, bond markets, through basically everybody. You could call it a policy put on the entire portfolio, but that's exactly what had to happen in the near term. So they have what they need to do going forward. Whether they're going to come up with more programs, I doubt it at this point. I think they've got enough programs. They need to do the implementation.
That was Catherine Mann of Citi Global Securities. Coming up, we wrap up the week with our special contributor, Larry Summers. This is Wall Street Week on Bloomberg. Welcome back to Wall Street Week. I'm David Westin. It is time now to get a sum up of the entire week. And for that, we turn to our special contributor, Larry Summers of Harvard, former Treasury Secretary. Larry, great to have you back with us. It's been quite a wild week, but you've been in the news, you yourself, the last couple of days with some reports about maybe some advising being done with Vice President Biden's campaign. What's the deal?
Oh, I wouldn't overread things. The Vice President and I have been friends for a long time, and I'm one of many, many people who his campaign talks to, but I don't have any formal relation of any kind to his campaign.
Okay, let's go on to some of the events of the week. A lot of them had to do with getting the economy started again, with Georgia getting out in front, actually opening up some businesses just today. The question is, are we going too fast? Have we really prepared for this? Do we have, and particularly the focus is on testing, do we have the testing we need?
I'll bet Georgia is going too fast, and I'll bet that's going to prove to be a dangerous mistake. But that's not the really important thing, David. The really important thing is that we need to spend macro money on the micro health issues. This thing is costing us $80 billion a week, more than $10 billion a day. Anything that we do that accelerates the pace at which the economy can reopen, that creates a more normal environment more quickly, will pay for itself many times over. But we're not throwing money at every possible approach to testing. We're not simultaneously building the manufacturing capacity for tests or vaccines that might work, but we don't know yet. What we need to do is spend money that we know some of it will end up being wastefully spent, so that we're ready to go with anything that works. A vaccine, a treatment, a test for evaluating, and we're just not spending money in that kind of way. We're throwing infinite amounts of money at leveraged firms that are over-levered and are having a tough time right now, but we are under-investing on a very large scale in the health investments. The truth is, the highest payoff health investments in moving the economy forward aren't in stimulating the economy. there in bringing forth the necessary health infrastructure in terms of tests, contact tracing, treatments, and ultimately vaccines. And that's where we should be heavily investing and concentrating, and we're not doing it. It's business as usual. It's the fact that we underspent on pandemic preparation that is why we're in this catastrophic mess, and we still haven't gotten past the error of underinvesting in health relative to other things. Think about it this way. If we move this forward by one day, the extra tax revenue that will feed into the government budget will be more than $3 billion. At that price, how could we not be investing in every possible experiment and parallel processing everything, knowing that even if we have some redundancy, even if we have some waste, it will be small compared to the benefits.
In the meantime, this week, Larry, of course, Congress appropriated another almost $500 billion. $100 billion of it was to go for hospitals and testing. The rest of it was for small business. One of the big questions now is, what about the states? Because the states are hurting pretty badly. We're hearing this from any number of governors. At the same time, the majority leader, Mitch McConnell, came out and said, you know what? I think some of these states should go bankrupt. We should just let them go bankrupt. What do you think of that?
I think it's madness. Why should we be spending hundreds of billions of dollars to support the junk bonds of companies that somebody bought up, levered up, and took a lot of money out, and not spending money helping inner cities where people are dying? Why should, when we talk about investing in America, look, you can argue both sides of whether this is a moment to expand infrastructure. But on what possible theory is this a moment for state and local governments to be slashing their maintenance budgets? On what possible theory should the federal government not step in and compensate states and localities for this disaster? Look, you could, and these arguments existed and were had during the financial crisis, you can discuss moral hazard, you can discuss whether it really should be ultimately localities' own responsibility. But at a moment when we are supporting every investment in every direction with trillions of dollars expansion in the national debt, how could it possibly be that schools for children, police departments, maintaining basic infrastructure and roads, supporting local hospitals, how could that be the one thing that isn't a priority? And then for Mitch McConnell to suggest that, well, they should just go bankrupt is as bad as the suggestions that, in its way, that aged people should just be left to die in the streets. This is not some liberal idea. This is just common sense. And by the way, Kentucky is one of the states that, in terms of its pension liabilities, is in the worst financial condition, and one of the states where, because of its failure to prepare for this in part, there's among the highest applications for unemployment insurance. And so I can't understand why he would let his partisan ideology trump the interests of his own state, which really is in very serious financial difficulty, in part because it's been over time overly committed to his ideology.
Larry, in the meantime, one of the big events of the week really was the cratering of the oil market with negative prices on WTI futures contracts. What do you make of that? Is that just a technical issue we have some traders that didn't want to take delivery of the oil? Is there something more profound going on there?
Well, I'm grateful that as an economics teacher, that now I can be talking about how prices can, in extraordinary circumstances, be negative. That wasn't something I'd ever seen before. The negative price reflected the precise dynamics of storage of particular categories of oil. That's not really fundamentally important. What is fundamentally important is that something that's basically good is happening. A cartel that over 40 years cost the world trillions of dollars is having difficulty maintaining its discipline. And as a consequence, consumers all over the world are benefiting. There was gasoline at close to $1.50 a gallon where I am a few days ago. That's not something that I would have ever expected to see. Fundamentally, that is an opportunity for households. It's an opportunity possibly to raise revenue by taxing. This is something that is going to help our friends, the American middle class, and is going to hurt Russia and Iran and Iraq and Saudi Arabia, the countries listed in your chart. So we should protect our supply potential and protect continued investment in new supply, but we should not be working to push the price of oil up in the United States. We should not be working to bail out oil investors who've had all kinds of windfalls at moments when the price has spiked up. And the single most obvious public policy idea in this moment is that we should be filling up the Strategic Petroleum Reserve. God knows there was a day when we could have been paid $40 a barrel to put oil in that Strategic Petroleum Reserve. So I hope the government will be more active in accumulating oil and less active in fostering cartels going forward.
One last quick thought, Larry. Are you at all worried about energy independence for the United States? Is that a priority for us?
Yes, although fundamentally there's one world, and if we're energy independent, but Europe and Japan are not, and they somehow prove to be enormously vulnerable and the price to them spikes, then the price to us is going to spike. So yes, I think we have more influence and power in the world because we have a strong oil industry. And yes, I support developing that as long as we can do it in an environmentally sound way. But I think this preoccupation with exact independence in a world where there's kind of a broad level of oil prices that affects everybody and is going to affect our allies, I wouldn't overdo that energy independence concept.
Okay, thank you so much to our special contributor, Larry Summers of Harvard. And that does it for this week for Wall Street Week. See you next time. I'm David Westin.